My name is Daniel Homlin. Today, our guest speaker is Matt Fore. Matt Fore is a technologist. He's actually in the sales group over at Dell, but he's also a real estate investor. He owns 10 single family rental homes, and he has a wonderful podcast called Ice Cream with Investors. And Matt, since you're here, I'm going to have to ask you our starting question. What's your favorite ice cream?
I'm going to give a shout out to my father, who told me when I was a kid to always get mint chocolate chip. And the reason he said that is because no one likes mint chocolate chip, so no one will ever ask you for a scoop. So I'm gonna say mint chocolate chip today.
All right. And we'll let you take it away. Feel free to introduce yourself.
Perfect.
I actually, I don't know if this is part of your speech, but I want to know if your Ironman training helps your mindset, your focus while you're real estate investing. Is there an overlap between the discipline that it takes to do that and the discipline that you put into your real estate investment? And I don't know if that's on your list of topics to talk about, but I would love to hear your thoughts on that at some point.
Yeah,
Doesn't have to be.
100%. It is not, but I will hit a slide that talks a little bit about Ironman, and we can kind of go over it then if you want.
Sounds good.
Cool. Thanks everyone for joining. I'll just jump right in. A quick introduction to who I am. No introduction is complete without some goofy pictures that maybe you're afraid to show the world, but will show a group of unknown people on the internet. But as Daniel mentioned, I'm a W-2 employee today, so I'm a regional sales director for Dell Technologies. I cover the Ohio, West Virginia, and Kentucky area, have 10 people rolling to us, and we sell primarily stuff to the data center. So server, compute, networking, storage. I say that because real estate investing and investing in general is not my primary role. And one thing that I try to help people do is figure out if they want to get involved in real estate because they understand the power of real estate or the power of investing passively, how can they do that? And because of 2020, I started getting a lot of questions around, what are you doing with real estate? How do I diversify my portfolio? I've heard this about real estate, but I don't understand the tax consequences of it. Could you talk to me about some of that stuff? So in 2021, I decided to start a podcast called Ice Cream with Investors. And really, the goal of the podcast is to bring on interesting people to talk about interesting things that hopefully provide value to others. And now, as I've had those conversations, I've started to notice that people will ask me different questions about particular things, and I can just point them to the podcast. So I would encourage you to check that out. It's a little passion of mine. It's a hobby of mine, and it's by far one of the best things I've ever done. So if any of you are thinking about starting a podcast on any different subject, I would love to nerd out about it with you and some of the learning lessons I've had over the past year. But as Daniel mentioned, I am a real estate investor as well. My single family portfolio is starting to dwindle down as we've seen the market appreciation here over the past year and a half. I've started selling out of some of my single family rentals and moving them into larger assets, such as multifamily units. So I'm a passive investor in.
I think somebody is muted. Matt. Matt, you're coming in through the phone number, right? Hello?
All right.
Can the rest of the group hear me?
Can you hear me now?
I can hear you, Matt.
Can
Can everybody else hear
Perfect.
us?
Yep.
Yes.
Okay. Yeah, we can hear you.
Perfect. So I'm a general partner in about 100 units. I have gotten involved in some fix and flip funds. So while I have done some flipping in the past, I recognize that it's better to be on the capital side of the equation for some of the headaches that I've had as a W-2 employee while also trying to do that. And then I own some various real estate notes as well, and being the bank and lending out some capital there. As Daniel mentioned, I'm an Ironman triathlete as well. So for those of you that aren't aware of what that is, it's a 2.4 mile swim, 112 mile bike, 26.2 mile run. Yes, it's all in a single day. Yes, it's all a single event. I'm just a glutton for punishment. That picture there at the bottom right is actually me competing in the World Championships in Austria, ZLMZ Austria, back in 2016. And that lovely woman right there is my mother, and you can see me giving her a hug as I come down the chute right there. Daniel, you mentioned what has Ironman really taught me in terms of real estate investing or investing in general. There's a couple things. I've actually got a whole talk track around some of the things that I've learned around it, but there's two things I would highlight from it. It's really, how do you set a long-term goal? And then how do you remain consistent day in and day out to achieve those long-term goals? I like to say that no one in the world was born with a natural ability to do Ironman distances. You just have to put in the work every single day. Unlike someone like, I hate to pick on him, but LeBron James, who's 6'8", 225 pounds of pure solid muscle and can jump out of the gym. That dude was born to be an athlete in some sport out there. Ironman is really about that consistency of knowing where you're trying to get to long term. And that if you miss a workout, if you miss a day, that's okay, but you can't pile up 3 workouts in a single day and expect to recoup some of that consistency. So what it's taught me really about investing is putting that money into passive investments, putting that money aside each and every paycheck, each and every week to make sure that I'm growing that. And man, 7 years now into my real estate journey, it has been such a huge relief and encouragement to see some of those compound gains grow over time. So that's me in a nutshell. I want to get into kind of the main topic of the conversation, and I will start by saying you all are the first to hear and see this presentation, so feel free if you see anything at the end of a typo or anything like that, please let me know. This is a work in progress, but it is something that I feel like answers a fundamental question. And the question really is this a good investment? Since I've started the podcast, since folks know that I'm really into investing and finances and how the whole money system works, there's a lot of folks that will come to me and say, hey, should I invest in this? Is this a good investment? What do you think I should do here? And I think before I can even start to begin to answer that question, you have to know 2 things. One is you have to understand the investment. So with some of the complicated investments out there, like loaning against account receivables or staking your cryptocurrencies on a 3rd layered blockchain or being capital in a private syndication and things like that, you have to understand what the investment is offering you. And I'm going to give you kind of like my framework for how I understand the investment, any investment. The second thing is I think you have to understand and develop a criteria for how you judge an investment. How I judge an investment might be different than how you judge an investment. So I'm going to give you a way for you to develop a framework to understand any investment and to judge any investment so that you can come to the decision on is this a good investment or a bad investment. I'm going to stop right here. And one thing I didn't put in the slides was this idea of principles versus tactics. So I'm going to recommend a book out there called Principles by Ray Dalio, and it is an absolutely phenomenal book. But one thing we say in our company a lot is that the world is moving faster than it ever has, but slower than it ever will be in the future. And why I bring that up is because I get asked questions all the time, like, what would you do in this situation? What should I do in this situation? I mean, as we're having this conversation right now, there's an invasion going on with an adversary and a potential ally. What would you do in that situation? And I think it's too hard in the fast, dynamic, changing world to try to answer those questions in one-off bases. Principles by Ray Dalio talks about how do you set principle-based decisions or principle guiding decisions criteria for you to not have to answer the specific question that's in front of you, but revert it back to your principles, run it through there to see what the answer is. So I talked about how to understand any investment, and this is called the Fore method. And if you didn't catch it, my last name is Fore, so this is a really bad pun on words, but we're going with it. So the first thing that I tell folks that they need to understand is really the financial liquidity of an investment. And then financial liquidity is basically how fast can I turn this asset into the market value? Not how fast can I get money from this investment, because as real estate prices drop, stock prices drop, and things like that, things become more liquid if you drop your price, but how fast can I turn it into market value? And the key here is that usually the higher liquidity something is, the lower returns you're going to get. That's not true for everything. I think everybody knows that. But a good thing to kind of think through and understand is that if something has higher liquidity, then you're typically going to have a lower return. So when you're looking at an investment, one of the questions you really want to ask is, how fast can I turn this into a market value? How long is my capital going to be locked up for? For some apartment syndications and real estate syndications, it could be 5 to 7 years. For things like REITs and option contracts and things like that, it could be as little as 20 seconds. One of the things that I talk about here is an example of a glass of water. If I take a glass of water and spill it over, water falls everywhere, right? That is a very liquid investment. But if I take that same glass of water, stick it in the freezer for a couple of hours, and now it's solid ice, and I take it out and spill it over, nothing comes back. That is a very low liquid investment. But if I take that same glass of water that's filled with ice and I let it sit out for a couple hours so that's half ice, half liquid, if I tip it over, then some of the liquid comes out. That's just a good example of how liquidity works, and that's the same in financial markets as well. The second thing I really try to understand is what is my ownership structure? And you're going to hear me say this a couple times, but ownership comes down to there's two different ways to invest in something. You can be the debt behind something, or you can be the equity behind something. And what you really want to understand is in the capital stack, where do I sit? As a general rule of thumb, if you're on the debt side of the equation, you're a little less risk adverse because you sit in front of majority shareholders in the capital stack. But because of that, you're going to have a little bit less of a return. If you sit on the equity side of it, then your appreciation on the upside could be a lot higher, but you sit behind the debt section of the capital stack. So if something happens, then you're the second person to get paid out. And I'm not here to convince anybody whether one is over the other. As you saw, I have single family rentals that I own myself. I have apartment syndications where I'm part owner or general partner. And then I have some debt in my portfolio as well where I am the bank and I'm lending out. It's just that you should understand where you sit in the capital structure more than anything. The next thing is returns. So when we talk about returns, there's really two different ways that you can get paid in returns. There's cash flow or appreciation. And again, I think there is room for both sides of that equation in your portfolio, both on the cash flow standpoint and on the appreciation standpoint. But it's important for you to understand when you're investing in something, where am I going to get my returns? Is it something like a Bitcoin or a commodity where most of the returns are going to come in appreciation? Or is it something like a debt structure or a real estate investment where most of the returns are going to come in cash flow? The key that you're trying to figure out is how much am I going to get from a return standpoint? And then when am I going to get it? Am I going to get it monthly, quarterly, semi-annually, yearly? Might not get it until the end of it if it's a development project. The key is for you just to understand how you're going to get paid and when you're going to get paid. The last one, and I feel like this is the most underrated thing that's ever talked about in investment, is what is your effort? And really, when we're talking about effort, we're talking about mental and physical effort and active and passive. So what do I mean by mental or physical? In mental effort, you could be having things that are high risk reward investments that rely on extreme amount of appreciation that you're worried about market timing. And I think that is a mental effort that you're going to have to carry with you. I'm not here to convince you whether that's the right investment or the wrong investment, but having that weight on your shoulders, knowing that you're playing the game of a greater fool, meaning that somebody else is going to have to pay more for the investment for you to make a return, carries a mental weight on your shoulders. A physical form of effort is being actively engaged in a business, writing software for a business, doing fix and flips and being the hammer behind, swinging the hammer behind the fix and flip. So there's two different types. There's mental and physical. The next one is really active and passive. So active means like I'm a general partner in a 100-unit apartment complex. So I need to be a part of the weekly cadences that we're doing. I'm a part of understanding as the property manager, finding quality tenants. What do we do when there's a problem, et cetera? Or am I a passive investor in something? So I mentioned some of the fix and flip funds that I'm in. I was the guy swinging the hammer on fix and flips for a while. Now I'm just the capital behind it. So it's more of a passive position. The key here that I'm going over is just a framework to understand any type of investment. I think with the amount of complications that there are in investments today and all the little tricky nuances that you can get in to squeeze an extra 1% or squeeze an extra 2% out of your investments, most people don't understand how they can maximize their investment or really what an investment is. And hopefully this is just a framework that you can use to judge any type of investment. All right. The next thing I want to talk about is developing a criteria to judge an investment. So before you can decide if something is a good investment or a bad investment, the answer is compared to what? You have to ask yourself compared to what? And so this is a framework that hopefully you can use to develop a framework. The first one is yield. So yield is really about cash flow or a dividend. So we know that a lot of active businesses, a lot of real estate portfolio investments provide cash flow as the yield, but in stocks and REITs and things like that, you might be able to siphon off a dividend. For me, yield, cash flow, dividend, understanding how I'm getting that weekly drip or that quarterly, monthly, yearly drip of a return or yield on investment is the number one thing I look for in investment. And the real reason behind that is because from an appreciation standpoint, I can't pay bills with appreciation. Now, technically, I can loan against it and all that kind of stuff like Elon Musk does and Zuck does to buy their houses. I get that. But for most of us common folk, the fact that Bitcoin has gone from $30,000 to $5,000, I can't tell the bank that I'm worth $5,000 more, right? So I think that yield, cash flow, dividends help us do two things. They help us, one, reduce our cost basis in an investment. So as I start getting those returns in form of a monthly yield or cash flow, then I'm reducing my cost basis because I'm getting some of my capital back. And then the second thing it does for me personally is it allows me to compound my investments. So my real estate portfolio is now to a point where I can take the investments or the cash flow that I get each year off of that and go move it into another asset and another asset and another asset, allowing myself to compound my returns. The second thing you have to understand is the equity. And you have to decide is the equity. And again, I'll bring it back up. You can be the debt or the equity. But I think that people should base their investment criteria on whether they're going to invest in something or not invest in something, at least a small position of their portfolio, on the equity they have in something. So I'm a big fan of Naval. I'm not even going to try to pronounce his last name because I will butcher it. But if you Google Naval, he has this series out there on Twitter and on YouTube called How to Get Rich Without Getting Lucky. And he talks about the fact that when you're trading your time for dollars, it's a poor trade because you'll never be able to get that time back. But if you trade your time for equity in something, then you have the ability to slingshot your growth and slingshot your wealth acceleration. So I believe that you should have something in your criteria that says, how much equity am I getting out of something? Or what's my equity position in something? The third one is taxes. And I am all about, somebody asked the question before we jumped on here about how can they reduce their tax liability. I am all for reducing your tax liability legally as best as you can because taxes are going to be the highest expense you have in your life, maybe beyond healthcare once you get into the later states of your life. But really it's because from an opportunity standpoint. If you think about the fact that when you were 21, 22, 23 and had to pay $1,000 in taxes, that might not have been a high expense for you at the time or even now, but the opportunity cost of what that dollar could have been in the future is the highest expense that you'll pay. So for me, I look for investment vehicles or investment asset types that have some kind of tax advantages to them. If I can't get a native tax advantage to it, so we know that real estate has a native tax advantage to it, meaning there's laws written into our legal system, our taxation system that says I can be tax advantaged because I invest in this asset class, then I start thinking about how can I make it more advantageous, whether it's putting it in a Roth IRA or using my IRA to invest in real estate, whether it's doing things like tax loss harvesting strategies and things like that. If it doesn't have a native tax benefit to it or advantage to it, then I want to think about different ways where I can make it advantageous. And then the last thing is inflation hedge. So I think if you're on this call, you probably have seen the news, right? And inflation is 7.2, 7.5% quarter after quarter, month after month now, it seems like. So I always want to be thinking about, is this asset class in general, will it naturally beat inflation of 3 to 4%? Things that naturally beat inflation, what I'm talking about there more than anything is things that are necessities to live. They're not luxuries. They're not entertainment. It's things like food, shelter, safety, things that are necessities to live. So again, I've given you a framework to kind of understand any type of investment. Here's kind of a framework for you to develop on how you can evaluate an investment or put some criteria around it to judge your investment. So I'll run through 3 examples for you all. I'll run through a stock market example of the S&P 500. I'll run through a crypto example with Bitcoin, and then I'll run through a multifamily syndication. Going through these, I want to make it clear, I'm not here to convince anybody that one asset class is better than the other. I'm just here to apply the frameworks to these different asset classes so you can make that decision for yourself. So let's start with the first one, the S&P 500. So looking at the Fore model, we want to first ask, does it have financial liquidity? Absolutely. I think the S&P 500 index, or specifically the SPY, is the most liquid asset out there that you can buy from a financial perspective. People are trading huge swaths of the SPY every single day, and the bid-ask spread on it is down to a cent. That shows you that there's a lot of liquidity, and the rarer something is, the longer it takes to sell, usually price discovery will widen. The more financial liquidity in it, the faster things sell, the more frequent things sell, the price discovery will shrink. So do you have ownership? I'm going to say no. I know probably the technical answer is yes, because you actually own 0.00001% of Apple when you invest in the SPY. But for the most part, the answer is no. Your shares don't mean any meaningful voting rights. You're not on the board. You're not making strategic decisions at the companies within the SPY that you own. So I'm just going to say no for simplicity's sake. Returns. So the SPY does give 2 different types of returns. You get an appreciation standpoint and you get a dividend. We can see here from a 5-year period that the SPY nearly 2.1x, and that's without dividends in it. So there is an appreciation value there, and you're getting dividends along the way. And then the last is effort. So I put it depends. If you're the type of person that feels like they need to follow the SPY's daily movements down to the hour, down to the 15-minute point, then that's a lot of that mental effort that I talked about. But from an active standpoint, like I just mentioned, you're not making strategic decisions at Apple, Intel, Dell, et cetera. So you don't really have that much effort involved with it. Your best option is just to be a passive investor and set it and forget it. So from a yield standpoint, it does yield, right? I think when I wrote this presentation, the SPY was yielding about 1.5%. Is that good? I don't know. You'll have to have your own criteria of what a good yield looks like, but it does offer some sort of yield. Do you have meaningful equity in it? No, you don't. Are there tax consequences for it? No. Now, I'll put a star there, right? I think everybody knows about the tax advantage accounts that you can put in things. You can have it in an IRA. You can put it in some kind of Roth structure, 401k, IRA, things like that. You can execute some tax loss harvesting on it if you want. It'll increase your effort on the investment, but you can implement some strategies there. But for the most part, there are no inherent tax advantages from going and opening a brokerage account and sliding $500 in the SPY. And is it an inflation hedge? For the most part, I'm gonna say yes. If you've looked at the stock market for the past 100 years, it's gone up and to the right. If you narrow in that view down to the 1 to 5 year realm, I think it's something like 93% of the time it's above where it was. So from a standpoint, when we print money, that ends up in investors' hands, whether those be institutional investors or retail investors, and typically a stop along the way before they go to the shopping mall to buy a new coat, it goes into the SPY somewhere. So I will say from an inflation hedge standpoint, yeah, I think it basically hedges against inflation. All right, Bitcoin. Here's the controversial one. Does it offer financial liquidity? I think yes, it does. I own some cryptocurrencies today, specifically some Bitcoin. And for the most part, if I want to get filled on a buy side or on a sell side, I don't really have any issues doing that. Now, the further you get away from Bitcoin into some of these altcoins, I would probably say no. The financial liquidity is a bit tougher. You're going to have that wider price discovery, that wider bid-ask spread. But for the most part, Bitcoin's pretty widely adopted now, and it does have pretty good financial liquidity, I think. Ownership. I put optional here, and I'm going to say yes, but there's a saying out there, not your keys, not your coins. I think you're starting to see more hacks on exchanges these days, And if you buy Bitcoin and leave it on an exchange and think that you have ownership over it, you do, but it's also anytime it's on an exchange and not off of an exchange in a cold wallet, then you're kind of putting it at risk, I would say. Returns. Yeah, I'm going to say you can only get appreciation with Bitcoin. I think everybody knows there's some advanced strategies out there where you can stake your Bitcoin and earn appreciation and things like that. But holy smokes, from an appreciation standpoint, when I took this 5-year snapshot, massive appreciation. Will that continue? I don't know. I think cryptocurrency is a thing. I think it'll be around to stay. What I can't tell you, though, is of the millions of cryptocurrencies and altcoins out there today, which one's going to succeed? So for the most part, from a return standpoint over the 5-year period that I'm using to judge in this presentation, it has appreciated. So we're going to give it an appreciation that's there. And then effort, I mean, I think it depends on your risk tolerance, right? I wouldn't say that any cryptocurrency should be the foundational base of your investment portfolio because of the mental effort it takes. If you're a person that doesn't like roller coasters with your investments, then probably it's not a good investment at all, because the mental task it's going to take to buy and hold crypto and be in it for the long term, I think will be successful. But in the short term, the mental effort of owning that is hard. Also, the active piece of holding it. So to take your keys off of an exchange and put it on a cold wallet. Now you have to make sure that you keep up with that wallet. You have to make sure you secure that wallet in terms of a fire burning down your house and burning down the cold wallet that you have it on. So the effort depends on your risk tolerance, but I think it's more active than something like buying an SPY. From a yield standpoint, I put no, unless you increase your efforts. So staking is where you can actually take your Bitcoin, take your keys, and stake them on different exchanges to provide other exchanges liquidity. We're starting to get a little bit more complex here, but you can get a yield on it. Now, what we have seen on that yield has gone down tremendously over the past 5 to 6 years, specifically in the past 2 years as Bitcoin becomes more liquid and it becomes more highly adopted. So I'm going to put no, it doesn't yield. But I think if you're a cryptocurrency advocate out there, you do know that there's ways to stake it and get a yield if you wanted to. Equity. I say no because not your keys, not your coins. And what I mean specifically by that is, again, moving those keys off of an active exchange and putting it into a cold wallet. If you're not doing that, then you have no equity or no meaningful ownership over your keys. I will also say no because Bitcoin is ultimately written on a blockchain and you have no meaningful ownership into the blockchain unless you set up a DAO or something like that, which is a whole separate conversation. Taxes. So here's where Bitcoin historically has no native tax advantages, but one of the most under talked about or under discussed tax strategies with Bitcoin is that it doesn't have to apply by the wash sale rule. The wash sale rule says that on stocks and indexes, specifically like SPY, Intel, Dell, and when you buy something on a stock exchange, if you sell an investment to harvest a loss, you have to wait 30 days before you can reinvest in that to fully be able to take advantage of that. Bitcoin does not, it's not a security, so it does not follow those same laws. So if I buy Bitcoin at $40,000 and the market takes a hit and it's down to $30,000 the next day, I can actually sell that $40,000 Bitcoin at a $10,000 loss for $30,000, then buy it again at $30,000 and it go up to $10,000. And until I sell it, I don't have to pay tax on the gain, but I can harvest the loss. So it's a really cool strategy that you can implement, and that's what I mean. Like if your investment vehicle doesn't have some kind of native tax benefit, then you want to try to think through how am I going to take advantage of other legal ways to reduce my tax liability. And then the last is inflation hedge. I hate to put this answer here, but TBD, right? We are in a time of historic inflation. We are at a time where there's now conflicts brewing up around the world, supply constraints around the world, all this kind of stuff. And taking out last year, I mean, we are basically flat for the past year and a half on Bitcoin. So is it an inflation hedge? TBD. I have an opinion on that, but it's still to be determined. The last is multifamily syndication. So from financial liquidity, no. Daniel can probably attest to this. When you invest in a syndication passively or actively on the GP side, you're locked in. You are locked in. Now, every passive syndication has some kind of T's and C's around can you sell early, how would you sell early, and things like that. But for the most part, multifamily syndication doesn't have a liquidity option. Ownership, so you can buy common share ownership. So most real estate syndication shares that I see out there have a 70-30 split. So when you're actually buying into that syndication, you're buying a portion of that 70% equity in the property. And look, on some of these smaller deals that I've seen, these $10 million, $8 million deals, when you can put up $100,000 to a $250,000, 250, and things like that, then you can have a meaningful ownership share. I will say that ownership share is limited, so your voting rights and management decisions and things like that are a little bit limited, but you do have ownership shares. Returns, so there's two ways you get returns in a multifamily syndication. There's appreciation of the overall real estate asset itself. That could be by increasing the NOI, by reducing expenses, or increasing the revenue. The natural tendency for real estate to go up and to the right, you're going to get some appreciation there as well. And then you also get a preferred return, which a preferred return, if that's a new term to you, basically means that you're going to get paid before the general partners get paid. And most real estate syndications that I've seen out there, now their cap rates are starting to suppress and things like that, but from a 5-year standpoint, you can usually get a 2x equity multiplier while getting cash flow along the way. And then an effort, if you're a limited partner, it's very minimal, if not zero. The funds that I'm involved in today, I get a monthly status report, and then I get a check in the mail, right? So very, very minimal. And from a mental standpoint, I believe that real estate should be the core asset in everybody's portfolio, one way or the other. So I believe that your effort is very minimal, and I don't really have to worry about whether this is going to appreciate and go up and to the right. I just can't tell you how long you have to hold it, but it will go up and to the right. From a criteria standpoint, so absolutely, real estate syndications do yield. We're seeing normal multifamily syndications average around a 7% preferred return plus the appreciation. So that brings your yearly return up to about 15% on most of the multifamily syndications. So it absolutely has a yield along the way, and you're getting appreciation. Do you have equity? Yes, you have 70%. You have a portion of the 70% of the common shares out there, so you have a meaningful equity stake. Are there taxes? Yes, I'd say there are 3 tax advantages to real estate. There's deductions, depreciations, and deferrals. So there are some native tax benefits to it. And as an inflation hedge, yes, I do. Yes, it is. Remember going back to the conversation about inflation, luxuries and entertainments are typically not an inflation hedge. Things that are needed for survival, such as food, shelter, and safety, are inflation hedges by their very nature. So again, I'm not here to convince anyone on a specific real estate versus Bitcoin versus SPY or specific asset class in general. What I wanted to do was, if you're a W-2 employee today and you're starting to become an accredited investor, which means you have different areas of opportunity to go invest outside of the traditional 401k, IRAs, brokerage accounts, and things like that, how can you develop a framework to understand any type of investment and then set up your own criteria to decide, is this a good investment or a bad investment? The key point that I want everybody to kind of take home is that your principles matter more than tactics. So as we continue to evolve our financial products out there, it's important that you have principles that say, this is the type of investment I'm looking at, and see if those investments fit into that, other than saying, oh, wow, this is a new shiny object, let me see if it's a good investment. My principal asset is my principal investment philosophy is I want to own cash flowing assets that appreciate over time, that have some kind of native tax advantage to them, and if I can get leverage on it, the better. Then that's a better form of me. So cash flowing assets that appreciate over time, that have some kind of native tax advantages to them, that if ultimately I can gain leverage on, then that's a good thing for me. So I'll stop right there. I actually can't see anyone out there on this screen, so I'm going to take that down.
Hey, Matt, we
And
got a couple of questions.
cool.
Can you hear me?
I got
All
you.
right. Always got to check those things. All right. Grace is asking, hey, can you evaluate mortgage notes on the criteria that you laid out?
Yeah. So on which side, the Fore or the Yeti?
She just says, can you talk about it?
Yeah, so I'll use the Yeti example. Mortgage notes absolutely do yield, right? So you are lending out money and somebody is going to pay you more money over time, and they're going to do it in monthly installments, so it does yield. Are there any tax advantages? Do you have equity? I would say yes, because if that person stops investing, then you are the ultimate lien holder, you are the ultimate asset holder. So I would say you do have meaningful equity. There are no tax advantages to owning mortgages, though. That is the one thing I would say, is that there are no tax advantages to it. And is it an inflation hedge? No, it is not. So I started down the path of trying to become a mortgage note SME. There's some really, really cool books out there. And if you like math, then mortgage notes and investing in debt is really just about math. You can make your offers based off of whatever criteria that you have. Invest in Debt by Jim Napier is a phenomenal book if this interests you at all, but it's not an inflation hedge. Ultimately, when you stick a set terms for 30 years, then you can't really adjust those unless they decide to refinance, and that's why you want to see banks, they're trying to refinance a ton. When we're talking about mortgage notes too, I meant to bring this up, but I'll bring it up here. When we're thinking about yield and returns, there's return on capital and there's return of capital. And if you're into real estate and into syndications, I would encourage you to make sure that you're looking at your operating agreements to understand, are you getting a return on your capital or return of capital? Here's what I mean by that. On my fix and flip loans, it's return on capital. I will lend Daniel $100,000. He will pay me 10% interest per month. And then in 6 months, he will give me my $100,000 back, right? That's return on capital. Return of capital is like a mortgage note where it's an amortization schedule. Part of that payment goes to paying you back. Part of that payment goes to paying your interest. So I don't know if that answered your question, but that's kind of how I view mortgage notes.
All right. Next question we have from Glenn, who's asking, as a fellow W-2 investor, do you find your investment portfolio, your podcast, etc., with these things, do you find the ability to leverage your depreciation, or do you rely on your spouse to do this? So I guess he's asking, can you take full advantage of the depreciation tax advantages, or is your spouse a real estate professional and it allows you to commingle your passive and your active incomes?
So good question. And one I did not know until 2 years into my real estate journey. So first of all, I'm single filing, no spouse, no kids, no dog, no goldfish. So unfortunately, don't have the ability to kind of maneuver that tax strategy. I do get the depreciation up to $150,000. Since I am above that $150,000 in my active income, then I only can carry forward that depreciation. It's very unfortunate, but if you make over $150,000, you can't show a negative loss on your K1s and write it off on active income. You can only write it off on your passive income. Now, what Glenn is saying is, if I also only worked part-time and was full-time realtor or involved in real estate, or if I was full-time but I had a spouse who did real estate and that was her form of active income, then we could take those depreciations, that carry forward depreciation, and apply it to all of our income. So I think that probably answered your question, Glenn. If it didn't, please let us know, come off mute or drop it in the chat. But unfortunately, since I work a full-time job, no matter how much time I spend doing podcasts and real estate, it's still going to say, wait a minute, the IRS, it would flag the IRS saying, you have a full-time job here and you have a full-time job here. When do you sleep? And we see that you do Ironman. So when do you do that?
They're constantly watching your social media for those things. Have you, Ashish is asking, have you actively looked at investment alternatives other than real estate? Have you found any that you recommend?
Yes, I have. I've looked at, so I bought a little small business, and I'm working on trying to like outsource somebody kind of running that. I've looked at franchise options as well, but I'm looking for a good operator that ultimately my goal would be to buy different businesses that are in the same industry that you could package together as a bigger business. But I want to have somebody go run those for me. I think with everything that I do, it's too much time. One investment I would put out there, though, is Bitcoin mining funds are really interesting to me. And the reason they're interesting to me is for two reasons. One, we still have the accelerated capital expenditure tax laws in place this year, which means that since the money that we are investing in the funds goes to buying computer hardware and things like that, they can write off 100% of those costs in year one. So it's a huge K1 negative loss benefit. I put in $100,000, I can show like $90,000 of K1 loss in that first year. The second thing why I like it, and Daniel and I have a mutual connection where their fund is set up that they do a 12% pref, 1% a month, and you can either take that in fiat or you can take that in Bitcoin. So my thought process behind that is it's a good place to put $100,000 of fiat, convert it into Bitcoin, take the tax loss, harvest loss up front, and then I just let that Bitcoin accelerate if it's going to do what I think it's going to do. And if not, it's, I already got the tax loss that I can carry forward anyways. So it's kind of a hedge.
And Matt, are you talking about Eng Tang?
Yes.
Yeah, he's been in here to speak, I think, twice. So if you're interested in his talks, he actually didn't talk about Bitcoin here, but you can go back and see him. He's on the Investors Hall of Fame page where Matt will be soon, and go check that out. I I've looked at his fund a fair amount, but I personally haven't invested there. But I know quite a few people that have, and
Mm-hmm.
I'm very curious looking over the fence.
Yeah,
All
and
right.
again, that has its own risk, right? You got to believe in Bitcoin, you got to believe in crypto, you've got to believe in their ability to set up algorithms to go mine that too. But that's just
Yep. Let's see. Juan is asking, can you talk about cost seg experiences on your single family homes or multifamily home investments? Just curious about your experiences in general and whether you did a cost seg on all your properties.
in the multifamilies, yes. In the single families, no. And the real answer or reason for that is because two reasons. One, I mean, the cost benefit on doing it on a single family really doesn't matter. It kind of doesn't make sense. And then two, I can't take those losses today, so I'm essentially shelling out for the cost seg study only to carry forward a loss in the future that in my mind, when you carry forward losses like that, the government could come in at any point and like claw that back out, which is why I'm a big proponent on always invest in your Roth 401k first and then your 401k second, because when you're doing just the 401 or traditional IRAs, then you're basically giving the government a loan that they can come take at any time. So I haven't done it. Juan, I would encourage you to go look at the Real Estate CPA podcast. They have a phenomenal take on how you can actually be a active short-term rental investor and get some of those benefits as well. So again, if you're over 150 in your W-2, then everything you invest in real estate will be considered a passive investment. You really don't get all the huge benefits from a tax perspective. But they were basically guiding me through, you can buy a short-term rental in November, for instance, and as long as you put in more hours than anyone else in that property, it doesn't matter if you meet that 750-hour mark to get real estate status. And that's actually something I'm looking at right now, is setting myself up for November to go buy something and be the short-term rental, spend a couple hours in December fixing it up, since I will be the person that has the most time in it, and being able to accelerate, depreciate that. Hope that answers the question there, though.
Yeah, a couple of comments. First of all, if you're interested in the Real Estate CPA podcast, Brandon Hall was in here. Go check the previous Speakers Hall of Fame to see his talk. Mark Perlberg, also a tax attorney, talked about the short-term rental strategy, and encouraged it. I've been looking into it as well. So I always enjoy hearing other people that do, and hearing how they build their deals or partner with people. So go check out those talks. And we have other questions here. FT. So Surya is asking if we are FT employee. I'm not sure what that refers to. Can we not take full time? Full time. Thank you. If we are full time employees, can we not take depreciation on rental properties? Can you please clarify?
Yeah. So if you're I try to do.
Just
if you're a
fair
full-time
warning,
employee,
we've got 5 minutes.
Okay. If you're a full-time employee, that is your active job. So that is your active income. There's something called real estate status, professional status. And Daniel, correct me if I'm wrong, but you need to show something like 1,500 hours or 1,200 hours per year to qualify as.
It's actually 750 hours per year, and the activity must be greater than any other number of hours that you've put into another job. So if you have, 40 hours a week over, however many long that is in a year, let's say it's 2,000 hours. If you were to qualify for real estate professional status, you'd have to put in 2,001 hours, which obviously, if you've got a full-time job, you're probably not doing.
Yeah. So the net of it is, if I make $10,000 in a single family rental income today, and I show a depreciation of $12,000, then I can show a loss of $2,000. I can't take that $2,000 and say, okay, let me take that $2,000 and apply it to my Intel revenue or my Intel W-2 and income. I can only show that my $10,000 of rental income is going down to zero, and then I carry forward that $2,000 loss that I had into the future years. So my net tax benefit going January 1 of next year is already at negative 2,000, if that makes sense. So basically, you can carry forward the loss, but you can't take it off of your W-2 income after $150,000.
All right. And then William is asking, did I hear you correctly saying that you're a fan of a Roth over a 401k?
Yes, you did. I think that if you have to pay the tax, regardless, today or in the future, pay it today. Now, with 1031 exchanges and the ability to pass that down through a trust, I'm going to tell you to defer your rental property sales through a 1031. But if you know you're going to have to pay the tax because you sold a car, a valuable, or whatever, then pay it today. Why? There's two reasons, really. One, if you look at the math of investing that extra dollar today or paying the tax today, knowing that at some point in the future, they are going to force you to take that money out so that you have to pay taxes on your 401k and your IRA. At the age of 69 and a half, I think you have to start taking minimum withdrawals. Then you might as well just pay it today. The numbers equal out. There's a number of different calculators out there that show the numbers equal out. The second thing is, I can tell you right now, even though I get kicked in the shin every time I have to write a tax check, taxes are cheaper today than they ever have been in the United States history, except for maybe 1913 when the tax law was introduced. If you look at the 40s, 50s, 60s, and 70s, they were super, super high. And I think that regardless of politicians, the only way to really fight inflation is to claw back fiat currency out of the system. And the number one way to there's two ways to do that. One, export it across the country, export it to foreign nations, or two, tax it out of the system. And I'm going to bet that with inflation as high as it is, and the fact that we have a $30 trillion debt, that we will ultimately tax at higher rates in the future. So the old saying of you'll make less money in retirement, so you want to pay the tax later, is not believing in yourself, first and foremost. I believe that I will be wealthier in the future than I am today. And second of all, it's just it's not true. When we looked at it, that was when you were paying 70% tax rates.
Hey, Matt, I had a person put it to me very succinctly. If you're deferring your taxes under the idea that you'll be in a lower tax bracket in the future, you are planning to retire with poor income.
Mm-hmm.
So,
yep.
That's
and I think it was Venezuela or Brazil. And if you talk to, so I spent a lot of time in Florida. And I have plenty of friends from South America, and they talk about like you've got this money in your coffers set up for retirement, and the government needs money. Where's the first place to go raid? They go raid the coffers of people that owe them tax but haven't paid them yet, and that's what the IRA and a 401k is future tax liabilities.
Well,
just a personal opinion.
As evidenced by them going into Social Security and Medicare, right? So.
Yep.
Well, and there was a bill going through the House to go after unrealized gains in a number of investments as well, and so they're definitely scouting around for future tax revenue.
Yeah, and think about it today too. Like I get the idea of putting money in your 401k and IRA because of the tax benefit today, but at the end of the day, unless there's a CEO of Intel on the phone here or VP or something like that, you're talking about a couple $100 that you're saving. And when you invest that money in a 401k or an IRA, it's going to compound over 30 years, which will be higher. So when you withdraw that money, you're going to have to pay tax on a bigger sum of money than what you have today. So there's this adage saying, would you rather pay tax on the seed or the harvest? Pay it on the seed. Just get it out of the way, pay it, move forward.
And with that, we'll say that neither Matt or I are tax professionals. Please consult your professional.
Thank you. I'm just a guy on the internet that likes learning about finance.
We're at 1:00. So everybody, can you take yourselves off of mute and thank you, Matt, and say thank you, Matt.
Thank you.
Thanks, Matt.
Thanks, Matt.
Thank you,
so
Matt.
much. Amazing.
Great
Thank
presentation.
Yes,
Thank
great.
you.
Thanks, Matt.
Enjoyed it.
Thanks.
Very cool.
Thank you, Matt.
All right, thank you, Matt. And do you have 5 minutes or 10 minutes to chat afterwards? Awesome.
Yes.
Actually, can I just meet you on Slack?
Yes.
Cool. All right. Have a great weekend, everyone.
Thanks, y'all.
Thanks, you too.